Hello everyone, I am Michelle. Welcome to this channel and thank you for joining me here. Before I start, please feel free to subscribe to this channel and switch on the notification button so that you will receive our latest e-learning seamlessly. Today, we're going to delve into a critical area of financial oversight, the Equity Risk Management Audit. Whether you're in internal audit, risk management, or portfolio management, understanding how to effectively audit this function is key to safeguarding value and ensuring strategic resilience. Let's start with a fundamental question. Why is equity risk special? Unlike credit risk, where you assess a counterparty's ability to pay, or operational risk tied to processes and systems, equity risk is the risk of loss due to movements in stock prices. It's driven by a volatile mix of company-specific news, sector trends, macroeconomic shifts, and global sentiment. It's unpredictable and, for many firms, a primary source of both opportunity and peril. The goal of an equity risk management audit is not to second-guess investment decisions. Instead, it is to provide independent assurance that the framework designed to identify, measure, monitor, and control these risks is robust, effective, and aligned with the organization's stated risk appetite. Today, we will walk through the core components of this audit. We'll cover the governance and strategy that sets the tone, the risk identification and measurement models, the limits and controls framework, stress testing and scenario analysis, and finally, data, reporting, and the audit conclusion. Let's begin. Our first and most crucial audit area is governance and strategy. This is the foundation. If this is weak, everything built upon it is vulnerable. We start by examining the 3 lines of defense model. Is it clearly defined and operating effectively? The first line, the portfolio managers and traders, do they own the risk they take? The second line, the independent risk management function, do they have the authority, expertise, and tools to challenge the first line? And we, in internal audit as the third line, must assess this entire structure. Key documents we scrutinize include the board-approved risk appetite statement. Does it concretely define tolerance for equity risk? For example, is it expressed as a maximum permitted value at risk or a maximum drawdown? Is it understood by the investment teams? We also audit the policies and procedures. Are they comprehensive, up-to-date, and accessible? Do they clearly outline roles, responsibilities, and escalation procedures for limit breaches? Finally, we look at culture and tone from the top. Through interviews and meeting minutes, we assess, is healthy debate encouraged? Are risk reports taken seriously by senior management and the board? A strong governance framework creates an environment where risk management is a strategic partner, not just a policing function. With a solid governance foundation, we move to the technical heart, risk identification and measurement. Here, we audit the tools and models the firm uses to see its risk exposure. The first step is risk identification. Does the firm have a complete inventory of its equity risks? We look beyond just price goes down. This includes systematic risk, exposure to broad market movements, idiosyncratic risk, exposure to a single company's fortunes, sector and concentration risk, overexposure to a specific industry, liquidity risk, can we exit positions in stressed markets, currency risk for international portfolios, counterparty and derivatives risk from using options, futures, or swaps. Next, we audit the measurement models. The most common is value at risk, or VAR. Our audit focuses on, is the VAR model appropriately calibrated? Does it use a correct confidence interval and holding period? Is the historical look-back period relevant, or does it miss major crises? We test the model's backtesting process, comparing predicted losses to actual losses. Frequent breaches indicate a flawed model. We also review supplementary metrics, sensitivity analysis, like beta or delta, tracking error for benchmarked portfolios, and concentration ratios. The key audit question: do these metrics, together, provide a holistic and accurate picture of the portfolio's risk profile? Identifying and measuring risk is pointless without control. This brings us to our third pillar, the limits framework and monitoring controls. A well-designed limits framework is the bridge between the high-level risk appetite and day-to-day trading activities. We audit this structure for completeness and logic. Are there limits at multiple levels? Gross and net exposure limits. They are limits, both single-day and stressed. Sector and country limits. Single-name concentration limits. Liquidity limits, like maximum position size as a percentage of average daily trading volume. Crucially, we test the operational effectiveness of this framework. Is the limit monitoring process automated and real-time or reliant on manual spreadsheets? What is the procedure for a limit breach? Is it clearly defined, and does it include mandatory escalation, root cause analysis, and corrective actions? We sample past breaches to see if the procedure was followed consistently. This area is often where audit findings are most actionable, uncovering manual workarounds, lack of system integration, or inconsistent enforcement of policies. Models like VAR are good for normal markets, but they often fail at the worst times. That's why our fourth audit pillar focuses on stress testing and scenario analysis, the what-if exercises for abnormal conditions. We audit the scenario library. Is it robust and relevant? It should include historical scenarios, like the 2008 financial crisis or the 2020 COVID market crash. Hypothetical scenarios, for example, a sharp spike in inflation, a regional conflict impacting oil prices, or a major technology sector collapse. Reverse stress tests, identifying scenarios that would cause business failure. We then assess the process and usage. Are these tests run regularly? Are the results comprehensible and actionable for senior management and the board? Most importantly, do they lead to mitigating actions? For example, does a stress test revealing vulnerability to a tech crash lead to a reduction in concentration or the hedging of some exposure? If stress tests are just a compliance exercise, they add no value. Our final technical focus is on the lifeblood of risk management, data and reporting. The principle is simple: garbage in, garbage out. We must verify the integrity, accuracy, and timeliness of data flowing into risk models. This includes market data, security master data, and transactional data. We trace a sample of trades from the front office system all the way to the risk report. On reporting, we evaluate if risk reports are accurate and timely. Relevant to the audience, the trader needs different data than the board. Actionable, highlighting exceptions and trends. To conclude, an equity risk management audit is a strategic, integrated review. We move from the boardroom's governance to the quants models, through the controller's limits, and into the crisis manager's stress tests, all supported by reliable data. A successful audit does more than check boxes. It answers: does the organization have a clear-eyed view of its equity risks? Is it within its stated appetite? And does it have the tools and culture to respond when markets turn? Our role is to provide that assurance and to offer insights that strengthen the firm's ability to navigate uncertainty, to protect value, and enable prudent growth. Thank you for your attention. If you found this e-learning is useful, please do subscribe to this channel and share it out with your friends and colleagues. Thanks again for your support, and have a great day ahead.